Hello, Paul Gerard, Price Accounting Services, back again in this series on interest deductions. Okay, so you've seen in the previous video, you should have seen in the previous video, an explanation of what is a joint loan. Now we're going to walk through identifying the problem. Now attached to this video, you'll have a link to a document you can download. I'm going to encourage you to pause it right now, print that document, and have a pen ready to fill that document in, because we're going to help you build the information needed for a pending fix. Okay, so what do you need to do? What you need to do is look at your most recently lodged tax return. That may be the 2024 or 2025 year. Okay, you then, but it could be any year. Okay, you then need to walk backwards. Now, walking backwards refers to the period of amendment that the ATO has available to it to amend tax returns. Typically, we're talking 2 years from the date of issue of the notice of assessment. So you might need to log into ATO or access your notice of assessment for each relevant year and ask yourself, am I outside of the 2-year period? If you're not, that is an affected return. So let's use the example of Fred, who's just lodged 3 years of returns and he lodged 2 years just a year ago. He could have 5 or 6 years affected by this issue. Fairly serious. So that's the first thing. You need to identify what years are affected. The second thing you need to do is what loans are affected. So you need to look at each person's tax return and look at who has claimed an interest deduction of any form. Okay. And it could be against a rental property, it could be against trust income, it could be against shares, ETFs, trust income, managed funds. It could even be a margin loan type of arrangement. Any form of interest deduction within that tax return. Okay. I've provided you with a worksheet to help you to fill out this information. Okay, so what you would need to identify is what is the present loan and what was it used for, if it's affected. Again, we're talking joint loans where it's not the same investor. So if, for example, it's Joe and Mary and they jointly own a rental property, we don't have to worry about that, because the joint borrowings matches the joint ownership. Easy. The same with shares. If you've got a joint portfolio and you've got a joint loan, no problem. Now, notice I'm not mentioning loan security. We never worry too much about what the loan security itself is. We're worried about what the loan use was. Okay, so if you're claiming an interest deduction on, let's say, 2 loans, you might have drawn some equity on your own home jointly, and then you might have borrowed the other 80% from a bank and borrowed that personally if you were, for example, Joe. Okay, Joe would only be affected for that joint loan with his wife, okay, for the deposit and the stamp duty and things like that, not the primary loan. So you've got to break it down and look at which loans are affected, which are joint loans where there is not joint ownership, okay? And then you record each of those. Then you're going to need to go back to day one. And on the right-hand side of that worksheet, you're going to progressively note down the record of each loan and its history. Who it was with originally, for example, it might have been with NAB, then after 3 years you refinance to Pepper, and then after 3 years you refinance to Commonwealth Bank. So we need present loan, and we also need the past loans. Okay, that'll give you an idea of how to reconstruct this. So in the next video, we're going to talk about what the fix is, what its limits are, and what our advice and guidance might be to resolve and address some of these issues. Okay, so we look forward to seeing you in the next video. Cheers.